Frances Donald is here with us. She's always got a spicy take on things. She's RBC Capital's chief economist. Frances, so where do you think the market is casting its vote right now?
Well, this is a market that doesn't like the econ data, but I might suggest this isn't just about today. We are facing, as Steve said, a huge amount of fog when it comes to tariffs, and it's real difficult to look at any data point and not make a broad proclamation about what it means for the U.S. economy. It's only the starting point for this new transition the U.S. economy is heading into. So when I look at U.S. inflation data today, I'm not thinking, oh, are we seeing signs that tariffs are coming into play? We're just at the very beginning of the tariff story. And the problem is we're starting out at 2.5% inflation, even without the inflationary shocks coming ahead. This is a market that's going to have to really become aware of the fact that a 3% handle on inflation this year is not out of the realm of possibilities.
I know, but the 10-year is down 10 basis points. We've gone from 436 to 426. I don't think that's the way it would behave. Right? I mean, maybe I should look at the shorter and maybe put back that chart, show the 2-year, show the 5-year. I don't know if we're flattening. We could talk to Rick about that. The 2-year also lower, 391. I mean, the yields are coming in. They're telling us this is a slowdown
but Kelly,
story.
Put yourself on the Fed.
Yeah. I love to think. Yeah.
Do that. Put yourself on the Fed. Governor Evans. When are you going to be cutting rates?
Well, see,
what is the inflation doing at the time when you're cutting rates? As if Frances is correct, and I think everybody has the same forecast, you have additional inflation coming through from tariffs.
Right.
Even if you think they're one time.
If you get one bad jobs report,
boom, you think the Fed forgets the inflation numbers.
And jobless claims, which, to be fair, have held up fine. They're absolutely fine outside of maybe the federal layoffs. But
let's ask Governor Donald.
Donald, what do you think?
I got to jump in here. We are accustomed to using all the economic data and saying, what does it mean for the Federal Reserve? I am spending way less time thinking about the Fed than I ever have in my entire career, because this U.S. economy doesn't need 2-year rates lower. It needs 10-year and 30-year rates lower. And the Fed is not the one that's going to create major influence there. The corporate sector, the housing sector, those are really leveraged to the long end of the curve. So my focus going into work every day is, what is that 10-year doing? When are we going to get relief for housing? And when are we going to start to see some alleviation in the burden of some of those higher levels of debt among consumers and households? That's not going to be what's happening with the Fed. It's going to be the market's interpretation of where growth is heading and what's happening in Washington. So we got to pivot the conversation a little bit away from the Fed, even though, of course, as an economist, it's my favorite thing to talk about.
No, I think that, look, the Treasury Secretary set the tone by saying the 10-year was his focus. My point is only that it'd be very easy for the market to come to a stagflationary outcome today, and that's not what we're seeing. We're not seeing bond yields move higher. We're not seeing that concern. I mean, maybe you could check on break-even, Steve, and they have moved up in recent weeks.
I'll call them up right now. They were a little bit higher when I checked yesterday, so that was another thing where there was some inflation. In fact, maybe Frances can double-check me on this. I think the term premium as well as the inflation premium were both rising.
Yeah, they're up a little bit.
They were falling. So I also want to show you, I don't know if we have these, but if you look at the inflation expectations inside the regional Fed surveys, here's the problem. Businesses are expecting inflation down the road. That's different from consumer inflation expectations. They take the price. Businesses make the price. So there's we looked at all the Fed and regional surveys yesterday, and here they are. Highest for the New York Fed since June 2022. Dallas, highest inflation expectation September 22. And on down the line, Philly Fed is the only one that's lower, but businesses out there are expecting higher prices down the road.